In this week's update, indices higher, but the major rotation continues. I'm reinforcing the rebalancing message, and let's do a quick check on the Bitcoin chart. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe to the video. Short-term perspective in the market is really quite interesting at the moment. We've had terrific earnings, and the earnings are still coming through at basically a record level. And so it begs the question, with some parts of the market starting to struggle and the seasonality that I've been talking about over the last couple of weeks, about what the market will do when earnings season winds up and there's nothing left to anticipate or get excited about. So I think that's really going to define how this market goes from here. But the difficult part of it is that we've got definitely a market in two halves, and it's flipped over from where we were in 2020. Last year, technology led the way very, very comfortably, and a lot of other sectors struggled, particularly finance, energy, those sort of sectors. Now that's all flipped around, and it's technology that is struggling on a relative basis, and it's other sectors that are doing really well. So, it may well be that the S&P index doesn't do very much at all, because we've got some sectors going up and we've got some sectors going down. It's just really hard to call at the moment. So I think that's really where it gets down to the importance of rebalancing your portfolio towards what's working now and what's not working. So I look at things from probabilities. That's all that we've got in the market, just the weight of evidence and the balance of where the probabilities may lie. And I think it's reasonable to expect that some parts of the market are going to struggle for the next few months, and that's going to lead to higher volatility. We've already seen plenty of fairly heavy selling in small cap, particularly technology stocks, and it's just so vital to hold the relative strength sectors, so the sectors and industry groups that are outperforming the rest of the market, and that's really where you want to have the bulk of your money. I think overall the risks generally favour the downside. The fact that the market has had such an incredible run, we had a move up in the indices to the start of earnings season. Earnings season has been just amazing. That has pushed some sectors up, other sectors have lagged, and generally the price reaction has been disappointing given the strength of the earnings. So I think overall the risks do favour the downside, so I'd certainly be cautious for the next few months. I would tighten up your stops if you're more of a trader type of participant in the market, and I would certainly demand lower entries for anything that you're going to buy. So I just think that's the bias that needs to happen. Now, when we look at the aggressive sectors, so they being technology, consumer discretionary, communication services, they're the three main aggressive sectors of the market. There are some targets within that. So some of those industry groups, I think, may do much better than the rest of their sector. And semiconductors is a very obvious one because of just the global shortage, and the outlook is really robust. So I think semiconductors are probably likely to outperform the rest of technology. And within consumer discretionary, if we look at areas like home improvement, obviously in America the housing cycle is absolutely booming at the moment, and everything that goes with that. So furnishings, durable goods, washing machines, fridges, those sorts of things. So I think those sorts of sectors or those sorts of industry groups within those sectors can probably do okay. All right, what are the risks to the market as a whole over the next few months? I think certainly one of them is that the Fed is forced, for whatever reason, or decides that they're going to taper their bond purchases. So they've been buying bonds to support the bond market and to support the government spending for a long time now, and it's still at a very high level. But if something occurs to cause the Fed to have to taper those purchases off, then that would be nasty for the market. And we saw what happened in the final quarter of 2018 when Powell started talking about that and raising interest rates. The market had an absolute heart attack over that, and I think the same thing would happen again, perhaps even worse, because the market is so much higher now. So that would be one of the risks. And in fact, we saw the Treasury Secretary Janet Yellen has already floated that idea through the week, and the market didn't react all that kindly to it. So she was just sort of floating the idea to see what the market reaction would be, and I guess to soften people up a bit for the fact that it's quite possibly coming. So I think that's a bit of a telltale that maybe the bond purchase program will start to get wound back a bit, and that won't be at all helpful for the market, I can tell you. She retraced from those comments, but it's pretty clear what the heck she's doing. The next risk is just politicians doing what politicians do. Grandstanding, making announcements, testing the market. And I think any deviations from the current policy, which is super accommodative with interest rates and with bond purchases, is not going to go well. So you put all this together with the market at record highs, a fantastic earnings season. It can't get any better than this. All the good news is out. What else is going to drive the market to the upside? So I just think there are more reasons in the shorter term for the market to go down than perhaps for the market to go up. There's also evidence too that there has been some what I'd call cascade selling, particularly in the tech ETFs. So what happens here, ETFs have risen for a long period of time because people buy stocks. That causes the demand for the ETFs to go up, and so ETFs rise as well. And so you get this reinforcing spiral to the upside. Well, of course, that can work in the opposite direction as well when sentiment changes. And I think we've been seeing some of that in some of the tech ETFs. And that cascade can get untidy because it's not something that is subject to a value judgment. It doesn't stop when the majority of participants think that there's been enough selling. It stops when the dynamic plays itself out. So those ones are a bit unpredictable. If we look at the earnings status, however, the number of companies that are raising forward guidance is at record levels. And that's really important for the market because the market looks forward 6, 9, 12 months. And more companies than ever before have raised forward guidance. So that's got to be a real positive. So turning to American stocks now, the S&P was up by 1.2% for the week. There are short-term divergences, which I've talked about over the last few weeks, particularly in the tech sector, where we saw just fabulous earnings. The price would gap up on the open and then sell off for the rest of the day and sell off the next day. So we're seeing those sort of divergences intensify, and that's why I think we're seeing some at least temporary tops in a lot of the technology stocks. Technology, however, was saved by a poor jobs report on Friday. So the fear around technology is that the economy is doing so well, it'll get overheated, inflation will start to rise, and that will cause the Fed to have to raise interest rates, or interest rates just going up under market forces. And certainly, I think that is overplayed, but that's what the market reality is. So that's been the dynamic since November of last year. But with a poor jobs report, that means that there's less pressure on inflation, less pressure on the Fed to raise interest rates, and so technology had a bit of a breather the last couple of days. But the leaders remain in financials, energy, industrials, and materials. So let's look at those charts. I will start first of all, just have a quick look at Bitcoin. So I've just left this the same as it was last week. So what can we tell from the chart? Well, we've broken this swing low here that formed in March. So we've now got a lower low. And at this point, we've now got a lower high. Now, this might just be a consolidation that's occurring here before Bitcoin moves up higher again. But you can only call it as you see it. And at the moment, we've risen back up into the range, which is not abnormal. This happens, all the time. This is a very textbook pattern so far. You break the swing low, you rally back, form a lower high, and then we get the third leg down. So it's quite likely at this stage that we're in the B leg of a counter trend correction, and that we've still got the C leg to go. So I still think that this scenario where Bitcoin could possibly pull back to 37,000 to 44,000, somewhere in this area, I think is still on the table. So if you're looking to buy Bitcoin, I probably wouldn't do it at the moment, because I think there's more potential downside until this clarifies itself, this little consolidation here. There's more potential downside than there is upside. Just let that pattern play out. So if we look at the S&P, new all-time highs. So closed at 42.32, and you could see just how much acceleration there has been since the last few little pullbacks that we had. The Nasdaq, not at new all-time highs, but still pretty elevated. So the Nasdaq is still doing pretty well, but the Nasdaq is a very broad index. It's not just about technology. And if we look at small caps also struggling a little bit as well. And that's just another piece of the puzzle. You put it in with the seasonality and everything else, and I think the way the S&P's going, I just think once earnings season starts to peter out, middle of March is often when the market goes off the boil. So it all fits to me. All the probabilities are starting to line up that we're in for some short-term weakness. Now, if we look at the individual sectors, so these are the ones that have been doing well all year. So this is energy. We did get a breakdown a couple of weeks ago, which I noted, but that turned out to be a false breakdown, and we're now back surging again, and energy is the most strongly performing sector in America over the last 3 months and 1 month, and certainly the last week as well. So energy still going very well. This is finance. You can see how well that's going, and it's been extremely positive in the last week. This is materials. XLB, so you can see again a real acceleration, a lot of support for gold, obviously a lot of support for copper stocks, and also for aluminium. Aluminium has been really strong in America, so that's a tremendous trend. And this is industrials, which again covers so many parts of the economy, but industrials have done well. Now compare all those charts where the look at the orientation of the 20-day, the 50-day, and the 200-day, and the big gap between the 50 and the 200, which shows how much the trend is accelerating. And then we look at technology. It's still going up on a big picture level, and definitely do not lose sight of technology. Technology is not dead, it's just going through a period where money is rotating away from it. But you can see that in the very short term, technology is relatively weaker than the overall S&P, and you can see that down here. We've actually got a downtrend going on here, which is the relative strength of technology. That line's falling, so that means it's underperforming the S&P, and that's why money is coming out of the technology sector. Okay, just while I'm here, we'll just look at the US dollar. So you can see we had a nice uptrend going, and then it all fell apart very quickly. We broke support, we've rallied back to support, and now the last 2 days has fallen away again quite sharply. And that's certainly helped the commodity parts of the market. The Australian dollar has, of course, pretty much the mirror image, and we finished up at just over 78 cents on Friday night. So the aggressive growth sectors remain near the bottom of the ranking, so they're not what you want to be playing in at the moment, but they certainly need to remain on your radar, because the American economy is going along really strongly, and these sectors, the businesses within these sectors, will continue to do well. It's just that what we're getting at the moment is a contraction in the multiples of sales, multiples of profit. The market is just not prepared to pay and sustain the same level of multiples that it was in 2020. So those multiples are being contracted down, but that doesn't mean that the businesses are still not growing very rapidly. And at some point, sentiment will swing back to these aggressive sectors. So they just need to be on the back burner for the time being. So the US dollar sharply down 90.2. The 10-year yield went down a little bit because of the jobs report. In fact, it fell a lot. It fell down to about 1.47 at the lows and then recovered a little bit. But certainly that's taking the pressure off technology stocks in particular. Now, the VIX spiked above 20 earlier in the week, thanks to the comments by Janet Yellen, that balloon that she sent up. But once she retracted her comments and the poor jobs report came through, which is good for equities, then the VIX ended up back down at 16.8. So calm returned by the end of the week. Our dollar 78.1, our index higher by 0.8, and it was really the financials and the materials that led the way in the Australian market. So we'll take a quick look at that, and then also at precious metals as well. So there's the Aussie index. So we're up at just under 7,100, which is not quite all-time highs. The all-time highs we saw in February of 2020 before COVID hit, but we're certainly getting back close to that. But it was materials that did really well, so that broke out as well to new all-time highs on materials, and it was financials that are also tracking along quite nicely. But interestingly, whilst energy has been the highest performing sector in America, this is the energy market in Australia. Now, I know the energy market in Australia is largely just 2 or 3 major stocks, Woodside and Santos, etc. But pretty lackluster performance by comparison. Turning now to precious metals. So precious metals had a very good week. You can see that we're now clearly in an uptrending channel for gold, and we're forming a series of higher highs and higher lows. I feel a bit more comfortable when we get back above the 200-day moving average, because I think that technically will bring in more buying support. But certainly there is a very nice trend happening in gold. And if we look at it on a weekly basis, so we retreated to exactly the 38.2% of this whole run from 2018, the lows in 2018, to the highs in August of 2020. So we've retraced 38.2, and now we're starting to head back up again. And we've cleared some important resistance in the process here at around 1790. So gold's certainly looking pretty good. Silver also started to pick up again, got back above 27 on Friday night. So things looking pretty good in the precious metals space. And if we look at GDX, we just continue to form higher highs and higher lows. We did have a downtrending channel here in GDX. So there's our downtrending channel, and we've now effectively broken out of that channel, and we've now started to form a series of higher highs and higher lows. So it's all pretty clear for the precious metals market at the moment. And again, we just managed to get above the 200-day moving average, which is important in this sector, because it's driven a lot by technical buying and selling. So just to wrap it up, sharply higher, 1831 is where it finished. Silver about 27.5, and the vital support for GDX that I talked about last week held, and we're in this uptrend. So you can only trade what's in front of you, and that's what's happening in the precious metals market. Now, copper had an absolute blinder last week and set a new all-time high of $4.70, and nickel also rose as well to $8.10. So a lot of strength now in this sector, and I've been talking about the commodities cycle for probably nearly 2 years now, and it's really now starting to get into stride. And in Australia, the local small caps are absolutely roaring. Whether they're existing producers or whether they're developing or even exploring. They're certainly in the copper and copper in particular, but also in the nickel area as well, are really starting to perform. Crude finished higher at 64.2. That's largely around currency, and as we saw, the stocks are back on the rise. So there's the copper chart. You can see over the last year, it's done extremely well, and now pushing up towards the $5 mark. Taking a broader view, there's 5 years worth of data on copper, so you can see just how strong that rebound has been since the COVID lows. And for nickel, we're also recovering, not quite back at the level we were at earlier in the year, but certainly nickel's starting to pick up again. So just to wrap it all up, I think at the moment you really want to try and keep it very simple. Just own more of what's trending now and less of what's not. But, the ones that we did so well out of last year, particularly in technology, don't lose sight of them. And especially semiconductors, because the outlook for semiconductors is just so robust. So I think at the moment, just keep it simple, play it with what is working, and just keep them on your radar. Now, Portfolio Analyst last week was really a lot about keeping your perspective really clear in what is a pretty challenging market. And it's challenging because we did so well in 2020 out of technology, and now technology is a real struggle. And it takes a while for people to start to accept that the balance of the market has changed significantly. And so that's what makes it challenging, that you've got to start to change the way you think about the market, at least for a period of time. So we spent a fair bit of time examining that. Obviously looked at the sectors that are trending now, looked at stocks and ETFs around those sectors to consider. So it was a pretty full session last week in Portfolio Analyst. And for anyone that hasn't taken that trial, it's available. I think it's very, very worthwhile thing to do. It costs you $1 for 2 weeks, and there's a whole archive of I think really valid material. So that's it for this week. There's the contact details, and I'll be back with you next week. And of course, wishing all the mothers a very good day today. That's it. Cheers.